Alright, hello everybody and welcome to a new video. I'm Victor from the Gembox trading team, and today we are going to talk about the roots and fundamentals of quantitative analysis applied to Forex. So the content will be the following. We are going to talk about quantitative analysis on time series, the characteristics of time series, some analysis techniques that we can perform, and time series properties such as the Markov property, and then we are going to talk about market efficiency and random walks, and last we are going to study the market with these techniques, and we are going to create some interesting trading systems that aren't common among retail traders, such as spreads. So quantitative analysis comes from the term quantifying. We are going to use mathematics and statistics to create models that fit into the market. This class we are going to learn mostly about statistics. Remember the term quantifying, that means that we are going to measure a magnitude on the market. We are going to measure certain data to extract patterns and analyze if the sample that we have took has some relevance on the market with the models we are creating. So what is a time series? This is a succession of data measured at certain times with a chronological order. That means we have a succession of data of close prices, for example, measured at a certain period of time, having a from date and a to date, for example 2010 up to today, with a chronological order. It can be spaced at equal intervals. In most cases, when we are talking about financial markets, it doesn't matter if we are talking about Forex or futures or even options, it will be always spaced at equal intervals. That is called a time frame. So we have over here an example of a time series. In this case, we have the observed succession of data and the time that the data was recorded or stored, or simply that the same time when that data happened. So what are the objectives of time series? First of all, we have the descriptive component. Is there a trend component here? Do we have a seasonal component? Do we have outliers in our data? And the second of all, and this is kind of more obvious because yeah, we are describing the time series, but we need to do something with this time series, otherwise this won't be useful. So we are going to try to perform some predictions using those to make an estimation about future data. So we have 4 components of a time series. Well, mainly we have one, that is the observed data, but if we perform a decomposition of this time series, we are going to get 3 components. First component will be the trend, second the seasonal component, and 3, and you can't avoid this, we are going to have some randomness that doesn't fit into the trend component and neither is going to fit on the seasonal component. Okay, so we have the trend, that is the behavior of the series evolution on the long term. If you observe this data about the monthly international airline traffic, we can see that it started on 100 and it peaked right about 600. So if we draw a line between those points of data, we can see that we have an uptrend. This means this is this chart, this time series, this data is rising up. But if we talk about Forex in the long term, we don't have a trend component really. I mean, yeah, the foreign exchange markets tends to go up sometimes, down sometimes, but we can say that it's pretty flat if we observe this data on a monthly time frame or in and even in a weekly time frame, if we observe enough data, we are going to see that we don't have a trend. At least in Forex, what do we have is a seasonal component. We have talked about this in the last video. If you haven't seen it yet, go and check it out. But a seasonality, for those who doesn't know the term, is a periodic and predictable variation that happens in less than a year. Alright, so let's look again at this monthly international airline traffic time series. We can see, alright, we have a rising trend, but we have some peaks and some lows each time, and we can even see that the space among those peaks and lows are mostly, we can say that we can extract here a pattern, and that is at the end of the year, the number of passengers on airline traffic tends to go really down. That means we peak nearly June, and we are right now in September, almost October, and we can see that the number is decreasing a lot. In Forex, this happens too. Doesn't matter if we are talking about a small time frame or a big time frame. You can find this kind of patterns in an 8-1 time frame or even in a daily one. And last, we have randomness, irregular, unpredictable, accidental movements. And when we are talking about randomness, there is a very interesting factor that comes into here, and it is the narrative bias. So, a small alert here, the narrative bias into a time series analysis. Alright, so the human brain is made for listening to stories. That's why we love books so much, TV series, dramas, comedy, even documentaries. Why? Because we are made to listen to these stories, to interpret the data, and we sometimes here we are going to end in falling into this bias. So this bias consists in I'm using a small part of the data that fits right into my thinking, but maybe this data is right, but most of the times will be wrong. If we extrapolate this to investments, we are going to use only a part of the data, and I'm going to discard the rest that proves me wrong. That means I think this company is very cheap in terms of price earnings, but if I look at the free cash flow or the return on investments, and it's for saying that in a straight and simple and family friendly way, that company is going bankrupt. But hey, it's very cheap in terms of price earnings. That means that it's going to go up, or at least I think that, so I'm going to buy. Okay, this is a great example. You are going to tell me what sounds better, and please put that in the comments. I want to really know what sounds better to you. So we are going to hear this, and please leave a comment. Tell me what example sounds better. First one: an IT company with stagnant sales, a drop of 50% on revenue, but according to the free cash flow model, the company is really cheap now. Okay, this is the first example, and yes, I'm going to dramatize this a bit, even more in the second. Second example: a military IT company that is suffering, but they hire a new CEO. He's a completely genius. He told on an interview with Maria Bartiromo that his new strategy is going to make the revenue go into higher, in the new all-time highs. The company is going to at least to replicate its capitalization due to a new technology that is patent pending. Sorry for my pronunciation issues, but I'm really excited just talking about you to the second example. Sounds exciting, right? Well, what if we are talking about the same company in both examples? Okay, if you have seen this movie, The Wolf of Wall Street, or if you have read the book, you may remember about a small company in the Midwest of the United States that is developing a huge radar system for military uses. And yes, what Jordan Belfort did was a scam, but he was using this negative bias to convert some facts, some small parts of the story into a huge one. And this happens every time that we turn on the TV, that we read the newspaper, uh, or even when we are talking to some friends and we are going to talk about a fun story, we are going to use this bias. And yeah, Victor, what does okay, when I'm trading, what is the narrative bias and why I should be aware of it? Okay, it happens on charts. Do we have an edge or not? You can see here an interesting meme, and I love a lot about it. Oh yeah, I found the bottom. Can you see it? What can we see in this chart is 1,000 trend lines that doesn't make any sense, but thanks to some randomness and mostly because most of the pixels of this screen are trend lines, we can see that yeah, maybe looks like some sort of trend, and our analysis is good here. No, don't be fooled by randomness. Let me explain. If I see a V-shaped recovery in the stock market, in the Dow Jones or in the Nasdaq, and I just see it one time, that it went great, that it was terrific, it was a perfect V-shaped recovery. Does it mean that every single recovery will be a V-shape and that I should try to buy the bottom? Trying to buy a knife that is falling down to the ground? No, at least if we don't know that if we have an edge or not. So, knowing that, we are going to talk about time series characteristics. We have two that are very interesting here. We have the mean, that is the average of a certain number of periods in the dataset, and the variance, the measure of dispersion that represents the variability of a series of data with respect to its mean. So, how can we translate this into market language? Okay, so we have a descriptive classification. We have stationary series, that means series with an stable mean and variance over time, and non-stationary time series with its mean or variance tend to change over time. So, what about markets? Yes, they change over time. We are going to find here a non-stationary time series. Alright, so now we know that market time series is a non-stationary one, and that is called an stochastic process in some times, and this is related to the Markov property. A time series or an stochastic process has this property if doesn't have memory. What does it mean? What does it mean that a time series doesn't have memory? Alright, its future value only depends on the current one. That means that we are going to check out a distribution of returns. Using the current price, we measure the returns and we are going to classify them. So this way we are going to know that if our assets, our Standard & Poor's 500 index in this case, is worth today about 1,000 points, tomorrow the most probable value will be 1,010 points. Why? Because most of the times is going to move around a 1%. And this is the standard deviation. The average that we already talked about that 0.029%, almost a 0.03%. This means that we have a bullish asset over the time. So you can see it also has fat tails. The maximum value recorded over 1 day is an 11.5% of going up, and the worst value is minus 20 and almost 0.5%. In this case, 20.46%. So this is the fat tails. We have our common distribution here. Most common values oscillating between -2 and up to 3, and the outliers in the data, values that doesn't happen very often, but they are huge. They are tremendous. This is a tremendous value, -20% in 1 day. If I recall it correctly, October of 1986, the start of the globalization of financial markets. But that's another story that we will talk about in other videos. So, there is a random walk theory over here. Sometimes the movement of the market is random. Not always, but sometimes. We can't explain everything. If we are going to explain everything, we are going to be fooled by the narrative bias and randomness. Oh yeah, I see a candlestick hammer pattern over here with a shooting star and some other fancy and exotic and ridiculous names that we can find in technical analysis. So this is associated with the market efficiency theory. I don't agree with this theory of the market efficiency, but I recommend you to study it. You have an article on our webpage, gemboxtrading.com, where I will debate this theory, but we are going to stick with the random walk theory. Sometimes the market can be random, sometimes not, or at least sometimes we can classify in what state is the market. So we are going to study the market with these concepts, and we are going to try to create some interesting and unusual trading systems. Okay, so we already see 2 ideas on this channel. We do a trend following. We did a trend following strategy on the Standard & Poor's 500, and we did some seasonality trading systems on gold and the Australian dollar. So you can see there is a continuation here about previous videos. I like to make everything structured to keep talking on the point that I left in the last video. So if you're not a subscriber, I will recommend it to you that you subscribe to the channel, and remember the currency of a YouTuber. If you like this video, please hit like, subscribe, and leave a comment, and this way you are thanking us for free to took the time to create this. So, and we are going to do a time series integration. We are going to model a time series that looks at least a bit more stationary, so we can extract patterns and play with this data. At least we are going to have a more stable mean, and the variance will be seen in another way. We are going to have an unstable variance, but the mean will be more useful to us. So in order to integrate a time series, we need to extract the return between the current price and the order of the integration. Usually we can do something like current price minus the price of the order of the integration, but I like to divide it. I prefer when we are talking about Forex, and this is my point of view, but always use a percentage return on every asset that you are going to analyze. Doesn't matter really if it is Forex or savings futures. So integrate a series of order 1, current price divided by the last price. So I took here a MetaTrader for platform, something really simple that almost everyone knows about. I made here a small indicator right down below the candlestick chart, where we can see how this works. In this case, we have sometimes that the market is performing about a 2% or a -2%, and others less. So, idea number one: is there a correlation between returns? Okay, we know how do we classify the distribution of returns, but we have a C score here, a set score, that indicates us that if prices rise up yesterday above a certain trigger, it will continue to keep rising up. Is there a positive correlation or a negative one? So, Canadian dollar against Japanese yen, a trend following idea. The number of trades is only 200, but keep in mind that we are using a weekly time frame. And what I did here is something like, let's see how the last weekend it ended above more than it went up more than a 0.5%. Yes, alright. So I'm going to be buying this week. Have some outliers here in the data, but mostly, as you can see, we have a stable pricing trend, a very interesting one. And in red you have the drawdown. Alright, so you can make the same into AUD USD with a trend following strategy in the time frame of 1 hour. And we can try different integrations of time series. Okay, I tried an order of 1, but can we identify trends using other orders? This case following the daily trend with an order of 5. As you can see, we don't have a big number of trades here. In this case, we have a bit more than 100, but this doesn't mean anything. We can, instead of create a trading system according to this set of rules, we can filter an existing trading system with things like, in the previous 5 days, the prices went up, so they are going to go up a little more. I'm going to create an intraday trading strategy based, for example, on breakouts that complies also with this condition. So, alright, we have talked about autocorrelation. We are going to talk about delta neutral trading systems. For those who doesn't know it, a large part of quantitative trading systems do not follow the market trend. This means we don't care if the price of a certain asset, such as the General Electric stock, goes up or down. We are going to look to a market set, to a set of assets. So, what is delta neutral? When we talk about delta, we are going to talk about trend exposure to the market direction. If I have a delta of 0.65, this means for every 1% that a certain asset moves, our portfolio will move at 0.65%. This is a usual measure on derivatives and options. More options than other derivatives, but how can we extrapolate this into Forex and CFDs and futures? The following strategy that we are going to see applies to almost everything. We are going to try to find a zero delta, at least related to the trend of a certain currency. Our objective will be the following: make a profit on the market, whatever direction it moves. How? For that we have two options. Arbitrage, that we are going to leave that to high frequency trading systems. We cannot compete with them, forget about that. So we are going to do some spreads. In this case we are going to do pairs trading. We want to value assets regardless of the currency. So we are going to forget about the US dollar. What if I value an asset in relation to another one? how many General Motors stocks is worth a single Ford stock. We are going to combine here the random walk theory that states that market movements are random, but they are correlated or in some cases co-integrated. I'm going to stick with correlation rather than co-integration. And we can see some relative valuations here. The price of gold compared to gold senior miners. In this case, we can see that we have a new chart, a new very interesting chart that we can trade here. We can also value the crude oil against Brent oil. Both are black gold, so to speak. So instead of valuing the oil in US dollars, that is what I can have in my pockets, and this is what creates some fear, that is the price of a certain asset. You know, crude prices are too high. My high octane gasoline is skyrocketing. I can't afford to put gas on my car. And that's a phrase that I heard from some guy with a sports car, a very expensive one that he couldn't afford to maintain it. So this happens when we are talking about the US dollar. But if I'm making a valuation of the crude oil that is going to be refined into gas and burnt oil that is going to be mostly the same, and the only difference between them is the refination process. I'm not a chemist here, so I don't know the exact difference in the refination process, but they have a high correlation, so market is telling me that the uses are almost the same. So how can we trade this? We can find assets with high correlation, or we can try to co-integrate them doing an augmented Dickey-Fowler test and testing its set score. But we are not going to talk about co-integration today. That's a long story that we are going to keep for other videos, in case that you show some interest in this one. So we are going to find some correlated assets. We are going to prepare the data, and we are going to create a trading system using this. So correlations are the simplest way to trade this, and there is a correspondence or reciprocal relationship in two or more assets. How can we find correlated assets? Very simple. We can find between sectors, countries, and asset types. We can find these correlations online, but I would suggest to you that for studying this, if you are a newbie, use Excel or OpenOffice. You have a correlation function, and I'm going to explain to you how to extract these spreads on Excel. Yeah, you can use Python, R, MATLAB, but let's going to keep this very simple, alright? So I have over here the correlation of results between senior gold miners, junior gold miners, and gold. And as we can see, have a 0.95 correlation between senior gold miners and junior gold miners. And there is a main difference between these kinds of companies. Usually senior gold mines have already do their research and they are exploitating mines. Junior ones mostly are small companies that either have small mines or they are only exploring current mines and they don't even know if they have some gold to extract. But either way, they are highly correlated, so great, I don't care what junior miners are going to do, because I don't care about gold right now. I care in a sector between high or big capitalization blue chips within the gold market and small caps. So we are going to prepare the data. We are going to do an integration, and we are going to convert it into a spread. So as this spread equals to integrated time series of senior miners minus integrated time series of junior miners. We have here the difference in percent return for each day. In this case, this is an integration of order 1 between the difference of GDX and GDXJ. J stands for junior. So if the spread goes above X, we are going to short the highest valuated assets, in this case senior miners, and I'm going to go long on the undervaluated assets. And if there is the inverse, if the our spread is below Y. Okay, so think of this as a forex pair. Instead of talking about Euro USD, we are talking about GDXJ, and its value is supposed to have a stable mean over time, but the variance is doing its own, as you can see over here. By the way, that's big data that went up more than 10% at this column outlier. So I'm trading both assets because I don't know what asset is going to go down and what asset is going to go up. Is GDX overvalued or is GDXJ undervalued? I don't know, but I don't care because I'm not evaluating this in US dollars, in euros, in loonies, Canadian dollars. No, I'm not going to evaluate this using currencies. I'm evaluating this among two types of companies. So I don't know what is the bigger if prices are going to keep up or go down, and honestly I don't care. So let's see once again the crude Brent valuation. When oil in the current or the front contract went into negative prices, what happened with Brent oil? Did Brent oil went down or up? So at first Brent oil didn't move. So I have my spread here. I buy crude oil and short sell Brent. A lot of people thought that okay, crude oil is going to rise, I just buy, but it kept going down up to negative prices, and it was Brent oil, that the asset that went down. So I always want to trade both assets here because I don't know what asset is overvalued and what asset is undervalued. I don't know the state of the market, so that is what I have zero delta, right? So another interesting spread, something very similar. Alright, this is an example. In this case, between 2017 and 2019, volatility was very low here, but silver senior miners and silver junior miners. We can also do this with stocks or even with CFDs. I can create new assets and trade ratios like SAG gold against silver. This is a very ancient ratio dating back 200 years ago. This ratio dates back way before the Dow Jones was created. We already have this ratio, but most of brokerage firms doesn't allow you to trade it, so you can create it on your own. Other asset that we can trade, a spread between Dow Jones and the Standard & Poor's 500. Instead of evaluating a financial index with money, with a currency, I'm evaluating one financial index compared to others. So in the case of a financial crisis, valuation goes down in terms of US dollars, but not in terms how many Dow Jones is worth the Standard & Poor's 500, because they are hardly correlated, but sometimes that correlation is going to be broke for a short amount of time. That is when we are going to trade this. We can implement this on almost every single trading platform that is released on the market. Maybe we are going to need to do two backtests instead of one, as is the case of MetaTrader 4. But hey, is it worth it? Yeah, it is. Why? Because it's a type of systems. First of all, it can help us to diversify our portfolios if we create interesting spreads between ETF or financial indexes or something like that. We can create new synthetic assets. I can create, say, if I have the pairs USD PLN and USD HUF, or USD NOK and USD SEK, that means Norwegian krona and Swedish krona. I can create a comparison between those both assets. Most brokers doesn't offer, in this case, the NOK SEK pair, but I can create this and I can trade it, and since the number of participants is so low, I'm going to extract interesting inefficiencies here. And of course, we can avoid certain risks related to currencies. I don't care what crude oil is worth in US dollars. Tell me what it is worth in Brent oil. So this is the end of the seminar. If you liked it, please hit the like button, subscribe to our channel, and you can find more information in our webpage, and you can learn about our machine learning trading engine that extracts inefficiencies for the Forex market. And I will see you the next time. Goodbye.